everybody, a very happy new year. This is Breaking the Mould. I'm Clara Hermit, and of course today I have with me Russ Mould, our investment research director. Happy New Year, how are you?
I'm very well, thank you. You?
I'm not too bad. It's
Good.
a brand new year.
It is.
Russ, what is the fuss?
The fuss, we're going to start off with a favourite topic, retail, shopping. I know Christmas is over, but we're now going to find out what all the retailers actually got up to over the Christmas period. So we've had a sort of pre-Christmas news famine, now New Year news feast, particularly from the nation's shopkeepers. John Lewis have got us off to a good start. Debenhams to an awful one. They sneaked out a profit warning a couple of days ago. So all eyes now on Next. FTSE 100 giant, trading statement Friday the 3rd, today actually.
So the stocks had a fantastic 2013, so what are they going to say?
Okay, well, consensus is looking for around a 3% sales increase to £3.7 billion, and pre-tax profits roughly flat at £670 million. Now, on top of that, big share buyback programme means that the earnings will actually go up, and that's one of the reasons why the stock did brilliantly, as you say, last year, going from £37 to 55, massively outperforming the index. Now, in terms of the underlying business, Next Directory, the market's looking for around 5 to 10% increase in sales. High Street, roughly flat, and that's going to be the benchmark not just for Next, but all of the retailers who report the next fortnight and beyond.
Okay, over the Christmas period, it's been pretty hard to avoid the heavy advertising for sales, hasn't it?
In fact, a lot of them got stuck in before Christmas, to be perfectly honest. Both Sports Direct and, again, Debenhams were very promotional, to use the word that they use, going into the Christmas period. And when I was lovingly dragged round the shops during the Christmas period by my better half, it was very obvious, looking at certain retailers, there was a lot of stock to shift and some very aggressive discounting going on. And in fact, retail's a great one for everybody to look at. It's easy to research. You can go to the shop, go to the website, look how much stock's kicking around, look at the pricing, and make your own judgment. And frankly, backing your own instinct is probably as good a way as any with these stocks.
So the M&S shares dived in December. So has that got the market particularly worried?
The market has been particularly worried about Marks. The shares have gone from 500p to 440 coming into the statement. And they did look to have a lot of stuff when I was dragged around there the other day, so we'll see. Big benchmarks there. Their first half numbers, non-food was down 1.3%. Food was doing really well, up 3.2%. So women's wear has been a big problem for them. So the general merchandising, the non-food numbers, where the real focus is, when Marks report on the 9th.
Okay, that's a big day, isn't it?
It's an enormous day. You've got Greggs and Tesco's on the same day, so it's an absolutely huge day. Tesco boss Philip Clark, he's been in the hot seat for 2 years. He's under quite a bit of pressure now. The shares haven't done much. He actually came out with the company's first profit warning for 20 years just after he started, poor chap. They're looking to improve on their third quarter numbers when like-for-like sales were down 1.5% and Eastern Europe had a complete nightmare. Now, Greggs, sausage roll seller, their boss, Roger Whiteside, isn't under quite so much pressure. He's only been in the hot seat for a year. But again, the market will be looking for improvement on a like-for-like of down sort of 2.1% in their third quarter.
Is that it for the retailers?
No, there's loads more. We could do all sorts of them, but Dunelm is the other one to watch. It's been a fantastic growth story, but they actually slipped out a profit warning in October. Very uncharacteristic. Like-for-like sales down 5.3%, and they actually blamed summer's hot weather for that. So we'll see what the December deluge did for their business, but again, they'll be looking to show some improved momentum there.
Okay, I am totally and utterly shocked out
Can't believe it. Refuse to have it.
I am, honestly. I've had enough. What else should we be looking out for?
It's macro. As always, we're getting off with a big start with the US non-farm payroll numbers on Friday the 10th, the US job creation figures. December was good, also the market thought, 203,000 new jobs. That followed on from November's 204,000. Any figure in that area will be taken as good news, seen as proof that the American economy is recovering and therefore the world economy is on an uptick. And that will obviously influence Federal Reserve thinking when it comes to their now $75 billion a month QE programme. Their plan is to get that to zero by Christmas.
Wow.
So we'll see whether they succeed or not. I've still got my doubts.
Yeah, maybe. Well, there it is. We are in 2014. We'll be back with you in 2 weeks' time. But until then, take care. Bye-bye.